The last type of loan we want to talk about is a mortgage or a home loan. In example 12, we have some initial information given, a loan amount, an interest rate, and a length of time for that loan, which can vary. We want to first find the monthly mortgage payment using this formula that we've used previously. So we plug in the initial balance, which is $258,650. The interest rate of 0.0475, a time of t equals 20 years, and making monthly payments comes out to 1671.46, which we would naturally round up, but even if that was 0.453, again, we would still round that up since we're calculating how much money we're going to owe someone. So that monthly payment would be $1,671.46. We want to find the total paid for the house in after 20 years. Let's get rid of that extra text there. We know that we're going to be paying a little over $1,600 a month. So that will be that $1,671.46 every month, so times 12, and then that amount times 20 years will come out to be $401,150.40. In part C then, what we're looking at is the cost of financing. So exactly how much we paid to be able to purchase this house in the first place. To do that, we look at how much we paid. That's that 401,150.4. And we subtract out the original balance of the loan, $258,650, which leaves us with $142,500.40, which means the cost of obtaining this loan and paying off our house was $142,500.40 over the original purchase price of the house. This is a number that shocks a lot of people. Well, both of these numbers. The first time you get into purchasing a home, it shocked me the first time I bought a home. There are obviously different factors that can help to bring that number down. Obviously, the interest rate, which is just kind of up to luck. Whatever the interest rate is when you go to purchase a house, that's varied quite a bit in my lifetime. But the primary thing that you can control is the down payment. The larger the down payment, the smaller the initial loan amount, so the less you have to pay off over time. In example 13, we want to consider a similar problem, but now we're going to bundle in what's called escrow. So escrow takes your monthly mortgage payment and adds in your property tax and home insurance, and again bundles all that together into a single monthly payment, where then the funds are distributed out to the city, the town, as well as your insurance company. So you're just paying a single amount and all of those other costs are being covered. We can find part A the same way we did in example 12. We'll plug the given values into that formula and we should get a monthly payment of $2,400.34. Then in part B, we want to find the monthly payment for the mortgage, now including that escrow payment, or the monthly payment including the mortgage and the escrow payment. First, we'll take a look at home insurance. Home insurance typically gets billed every 6 months if you were just paying for it without escrow. So to get that monthly payment, we'll take that $850 divided by 6. Or a monthly payment of $141.67, if we round that up. Next, for property tax, we have to look at the assessed value of a property and the property taxes in your area. So we would take that property tax rate of 6.9% or 0.069 times the assessed value of the home and divide that into 12 monthly payments. In this case, that would come out to be $528.14, if again, we round up. So to calculate the total monthly payment, if we're paying for our mortgage, insurance, and property taxes, so paying for everything in escrow, we would take the $2,400.34, and then we would add in the $141.67 and the $528.14 to get a monthly payment of $3,070.15. Now, in this case, we're not paying anything more than usual. If it does turn out that you end up overpaying, your bank would refund you that money at the end of the year. What this does is just ties all those payments together versus you having to make separate payments to your bank for the mortgage, your insurance company, and to the town or the city to cover those property taxes. In particular, it helps with budgeting because you have a controlled fixed amount versus insurance that pops up every 6 months, property taxes that are paid typically twice a year. So it doesn't save you or lose you any money. It's just an alternate way to cover those costs.